The opinions expressed on the following program are not necessarily those of this network or its sponsors.
Well, on today's show, we have a real special guest. We have a gentleman named Brian Elbogen, and he's one of the directors over at Unison Company. And to be honest with you, I had never heard about this company until about 2 weeks ago. And I got this little mailer in the mail, and it said I was pre-qualified for a loan of $43,900 with no interest, no prepayment penalties, no cost. I'm going, this is just too good to be true. I had to check into it. I did some research online, and I'm going, it is true. I was just shocked. Brian, how are you doing today?
I'm doing great, Charlie. Thanks for reaching out, and I'm glad to be speaking today.
Well, good. Tell me a little bit, how did this whole product come about?
Sure. So the company that I work at, Unison, what we do is we make co-investments alongside people either looking to buy a home or people who already own a home and are looking to get liquidity out of their home to pay for college, pay for retirement, pay for other life needs without having additional interest rates, having additional monthly payments. And really that's the unique concept, is that everywhere through home ownership today, when you're looking to buy a home, you take on debt by getting a mortgage. When you're looking to take cash out of your home, you get a home equity line of credit, which is also debt. If you want to stay in your home as a senior citizen, you're taking out a reverse mortgage, which again is more debt. So everywhere across the entire spectrum of home ownership, your only solution historically has been debt. And that's where the origin of this comes from, is in every other major asset class, every other major investment that we have in our lives, typically you can combine some combination of borrowing money in a loan and also having investors, people who actually partner with you to make you more successful. This is true for small businesses. This is true in commercial real estate. We have a whole stock market for it. But in the world's largest asset class, and the one that 90% of people care the most about because it's the roof over their head, your only solution has historically been to borrow more and more money. And so that's the whole origin of this, is how can we solve for life needs that home buyers and homeowners have and enable more choice that you can't have by just using debt, where the combination of these two things can do more.
Well, cool. I get the concept of a co-investor, if you will. But my thought is that's always when you buy something, you have an investor. What you're doing is you're coming in after the fact, and you're saying, I'm going to buy into your property now that you may have had for a year or 10 years or whatever. Isn't that risky on your part to buy into something that already exists and has a value?
Sure. Well, it's a great question, which is the broader question of who would actually want to, why does this exist? Who is interested in investing alongside homeowners with no interest rates, no monthly payments, where home prices can go up and we share in the gain, home prices can go down and we share in the loss, and you can basically partner with us for 30 years. And so if I can explain who's actually interested in that type of investment and why that makes sense for them, then you start to see why this whole thing works. And the way to think about this is, if you're an individual homeowner, you have an investment in one property, in your house, and that's the roof over your head. Right. And when you're in an area like Las Vegas or any individual city, you have lots of volatility, lots of fluctuations that can really impact your lifestyle if home prices go up or if home prices go down. And these people, when you're a homeowner, have very short time horizons. You're typically going to live in your home between 7 to 10 years. And most of your entire net worth is tied up in that roof over your head. So if you compare that versus some of the world's largest investors, these are, let's call it pension funds or university endowments. These are very large institutional investors that have very long-term horizons. This is, if you think about the UNLV, University of Nevada, Las Vegas, they have an endowment whose job is to make sure that they can stay funding their mission as an educational institution for the next 50 years. And they have to worry about things like construction costs and professor wages and retiree costs, not just today, but 50 years from now. They're looking to get long-term exposure over very long periods of time to real estate, because that exposure helps hedge inflation for them over very long periods of time. And they're not investing in one home, they're investing in thousands of homes across the country, which gives them a much more diversified exposure than an individual person can have. And so what we're doing is solving for two needs at the same time. You have very large investors who are trying to just keep the lights on from an educational perspective, or pay out their pensioners for their retirement costs. So we're solving their need over very long periods of time. And at the same time, we're also solving for the needs of consumers and customers who have liquidity or have a home or probably have too much exposure to it and may have other life needs where they need liquidity without monthly payments. And that's why this whole thing works, is that you're actually solving two problems at once.
Okay, very cool. So if I have a house and let's say it's worth $500,000 and I owe $400,000, I have $100,000 of equity in there. So what you're saying is you're gonna buy into my house, into the ownership of the house, based on the amount of equity I have, or is it based on the amount of value the property has? I'm a little confused.
Sure, no, that's a good question. It's based on there are certain qualifying criteria based on how much equity you have in the home. For example, if your home is worth $500,000 and you have a mortgage that's $500,000 and you don't have any equity,
right,
that's probably a solution we can't offer. But let's say you have meaningful equity in your home. The amount that we can co-invest is not based on how much equity you have. It's based on how much your home is worth. And so, for example, we offer a lot of flexibility on how much we can co-invest based on what your needs are. If you have a $500,000 home and you'd like for us to invest 10% of the home value, which means that we can co-invest $50,000 with you, we're able to do that. If you want to increase the amount that we co-invest, we can go all the way up to, in some cases, 20% of the home value. And we can go as far down as 5% of the home value. So it's very flexible based on what your needs are, and how much we share in as a co-investor depends on how much we co-invest. So the more that we co-invest, the more we share in the gain, and more we share in the loss concurrently. Okay. And if we co-invest less, then we share in less. And so you have the flexibility to decide what's comfortable for you in terms of how much you like in a co-investment and how much you want to partner together.
Okay, so really it's a function of your credit rating, I guess, first of all, and then whether you actually have any equity at all. And if you do have equity, it's based on the value of the home. Now, how do you get paid back when you invest into a home?
Sure. So let's take an example, and just answer your first question. If you qualify for the program, from a credit perspective, from the location that it's in an area that we're co-investing currently,
right.
It's really the primary measure is how much do you want us to co-invest and what's your home worth, and those are the primary things we use to determine how much we would partner together. And so to your second question of let's take an example, how we actually get. When do we actually receive our share of the investment? And so let's say we partner with you on a $500,000 home, and that $500,000 home goes up to $600,000.
Okay.
And this could be over a 5-year period. This could be 30 years later. Anytime between our point of partnering together all the way up to 30 years later, that's how much flexibility you have in terms of when you can decide to exit the agreement. So you as a homeowner who has this $500,000 home, you can choose to sell your home at any time, or you can choose to buy us out without selling your home anytime after 3 years. So there's a lot of flexibility for you to stay in control of your home because it truly is your home.
Okay.
When you tell us that you're ready to end the agreement because you're selling your home or you're ready to buy us out, then we determine that current value of the home at that point in time, and we use that as the price for determining how much we share. So, for example, if that $500,000 home goes up to $600,000, and you tell us that you're ready to sell your home, we would share in some percentage of that increase of $100,000 because your home went from $500,000 to $600,000. We only share in the increased value.
Okay.
So you as the homeowner keep all of the existing equity you have in the home. You as the homeowner get to keep all of the principal payments that you continue to make on your mortgage. You continue to get any additional home improvements that you make to the property. You get the benefit of that additional value that you've created. It wouldn't be fair for us to share in those things. The only thing that we share in is that change in value from when we start the agreement to when we end the agreement.
Okay.
And so in that same case, if that $500,000 home goes down to $400,000 and you decide to sell your home, we'll actually share in that loss with you. We'll share in that $100,000 loss, and that reduces your loss as a homeowner. So we are truly aligned with you as a partner. We co-invest at the real value of the home. We share symmetrically when home prices go up and when they go down. And that means that we're incentivized to work together in order to make you successful as a homeowner, because we only win when you win.
Very cool. Now, one thing just came to mind. You were talking about the future increase. Let's say you buy into my house now, and you give me $50,000. I take the $50,000 and I go buy a new kitchen. I put a whole new and that increases the value of the property by 30,000 because you never get 100%. You said any improvements. How do they handle improvements to a property over and above?
That's right.
So
yeah, it's a great question. So the way that works is that we have a process that makes sure that any lasting value that you've added to your property when you decide to end the agreement is your value. It's something that you've put in the time and the money and the energy to make those improvements. It wouldn't be fair for us to share that. So for example, there are some renovation projects that really add lasting value. It's things like square footage, adding an extra bedroom or a bathroom, or adding a garage or a pool.
Right.
And so when you want to do a home improvement, because you're in control, you're always allowed to do whatever home improvements you want. You give us a call, you let us know about the improvements, you send over the pictures so that we have some idea and we can put that in your record.
Okay.
And then when you decide it's time to sell your home or to end the agreement, you just let us know, and we have in our file that there was an improvement that you made. And when it comes time for the appraiser to come in, an independent third-party appraiser, to determine what the home is worth and where is the value being attributed, we'll be able to point to that person and say, reminder, they added an extra bedroom in 2018. And so when you do your appraisal, this is something that appraisers do anyway, is tell us exactly what is the component of the value associated with that bedroom, or the extra square footage they added, or the basement that they've added.
Okay.
And so whatever the appraiser says, here's the value, that kitchen in this case is still a new kitchen and has increased the value by $30,000. That's $30,000 that we adjust on the price that we don't get to share because that's yours.
Very cool. Okay, so you have an independent appraiser. Do you select that? Do I select that? Do you have an independent? How do you do that? You don't use Zillow, right?
That's right. Correct. It's an independent third-party appraiser. So we have an appraisal management company that we can order an appraisal from, and they will select on their side an independent appraiser that we have not selected, who will go out and will actually do the appraisal. So it's truly arm's length, and we both look for a fair value in this.
Okay. Now, if I'm selling the house and I have to get an appraisal in the house to sell it, can you use that appraisal, or do you need a separate appraisal?
The good news is if you're looking to sell your home, the actual price that we use for the home is the actual selling price. And same with if you're looking to buy a home, we use the actual market price when you buy the home in order to start the transaction. So in this case of a remodeling adjustment, if you're already getting an appraisal on it and we can point to that appraisal and they can follow the instructions to just itemize that additional improvement, that's generally okay for us.
Okay. So if you're selling the house, you don't need the appraisal because it's the contract sales price, obviously.
Mm-hmm.
Now,
Exactly. We want it to be as close to the actual market price as possible, and what better market price than the actual price that it's sold for or that it's bought for. And if that doesn't exist because you're still staying as a homeowner,
right,
then the next best solution is an independent third-party appraisal.
Okay. Now, let's say I got equity in my home and I would like you to co-invest. I'd like to take that money and buy another house, a rental income property, or a second home at the beach or something like that. Any provisions as far as the future property, or is that completely independent?
You can use the money however you want when you co-invest with us with the homeowner deal. And in fact, we see a lot of interesting use cases about how people use those proceeds for real estate. For example, the example you gave, we have many people who will use a homeowner transaction with us on their owner-occupied property to make that our co-investment now becomes the down payment for them to get their vacation or the rental property.
Okay.
We see other examples, for example, of parents who want to help contribute gift funds for their kids to buy their first home. And what they will do is partner with us on their own home with a Unison transaction to use those proceeds as a way of funding the down payment for their kids' own home.
Okay.
And lo and behold, we can actually help with their kid who's also buying their first home with giving them Unison funds as well to contribute towards their down payment. So we've seen some really creative and flexible use cases for how people decide to partner and use the proceeds of how we co-invest with them. And that's what's been really exciting to see with a lot of our recent customers.
Very cool. Now, let's say I'm in love with this. I want to do it. Okay. What kind of cost do I have up front?
Great question. And so up front, we go through the entire process together, and the all-in cost for our homeowner transaction is 3.9% of the co-investment amount that we partner with. So for example, if you have a $500,000 home and you'd like for us to invest $50,000, then our origination fee, our fee that you would pay out of those proceeds is 3.9% of that $50,000.
Okay.
And so now included in that 3.9% is that all the costs associated with the transaction, the property inspection, the appraisal, these are things that we will take care of on our side. So it's an all-inclusive price for our homeowner transaction.
Okay.
And then after that, there's no cost. There's no ongoing fees. There's no monthly payments. The only cost is that we're co-investment partners together. And so if the home goes up in value, then we both share in that gain. And if the home goes down in value, we share in the loss.
So in that situation, you just gave me $50,000 and you took $3,900. I can take that out of the 50, obviously. To
clarify, it's 3.9% of the $50,000. So it would be half that. It would be, I would have to run the math in my head. 1950, I believe.
Okay. So 50,000 minus 1950, you give me a check. And out of the 1950, you pay for the appraisal, the transfer title, tax, all the county recording fees, all that kind of stuff, because now you're going to be on the title, I'm assuming.
So we're not on title. So the reason we pay for all those fees is that all we're trying to do is make sure that we are we're working together through a transaction. But the way that our investors partner with us is really around the long-term co-investment. We're not trying to make a significant revenue stream up front. It's really about us working with lots of partners.
So that's really just to cover your costs and that type of thing.
Exactly.
Your game is at the end when you sell it, and you get a percentage of the increase. And that's fair.
That's right.
I mean, because you're putting the money up front for that. That is so cool. I mean, why isn't anybody else doing this? I mean, this is just amazing.
Yeah, well, it's we ask ourselves that sometimes, and I think one of the real reasons for it is that it's trying to create something completely new in an industry where it's hard to do anything new. And when you think about all of the regulations and requirements it takes to do new innovative things in other spaces, it becomes substantially harder and more complicated when we're dealing with something that's as important as people financing their homes. And so a lot of the history of our company is really working with all the different stakeholders and regulators and lenders to educate around how this concept really actually solves for a lot of solves for everyone's needs, because it's bringing additional investments into homes as opposed to requiring people to just borrow more and more money. And so we've spent years working with various federal and state regulators to get them excited about this program. We work with several large lenders who partner with us to help people buy a home, where they'll originate a mortgage alongside our down payment fund. So in Nevada, for example, we work with large lenders like Guaranteed Rate and People's Mortgage and Homebridge and RPM and Goldwater. And so all of these lenders are excited about partnering with us because it enables them to help their clients afford more home, lower the monthly payments, and it gives them an opportunity to differentiate themselves versus other lenders in the space.
Well, it's such a great way to use your equity in your home to do other things without having to increase your monthly outgo. So basically what you're doing, you're investing in the future. I mean, Tom Selleck's going to have to get a new job after this, because I use it because he's we think that there are a lot of solutions, especially for people who are retired. This gives them an opportunity to stay in their home while still getting some additional liquidity without having the additional burden of monthly payments. And so we think there's great opportunities there. The one that I also think is really exciting is we're talking a lot about people who already own a home, but in a market where you have lots of first-time home buyers or people who are trying to get into a home, especially where home prices have gone up significantly. I mean, Las Vegas in Nevada, I think broadly went up on average 13% year over year on home values. Right.
And so for these people just trying to get into a home, the number one challenge they have is, how do I come up with enough of a down payment in order to be able to get into a home? And so our home buyer program, that same concept where we can co-invest with you, we also enable home shoppers to become homeowners. And the way that we do that is, if you as a home buyer make a 5% down payment, we'll contribute an additional 15% as a co-investment to get you to that magic number of 20% down. And now, because you have 20% down, you can get a normal mortgage with a normal interest rate. And because you have 20% down, we've gotten rid of mortgage insurance.
Well,
and so there's all these.
Their payment. It was perfect.
it can lower your payment substantially. So for example, for the typical Las Vegas median home, which is around $220,000, if you're trying to buy a home with only 5% down, you need to make as a household $62,000.
Right.
But if you can get a 20% down payment, then that drops substantially. I think it's somewhere around $47,000 as your income. And so all those people that only make $50,000 can now go from a place where I can't afford to be in a home to I now have a solution to become a buyer today instead of trying to save up for the next 2 years. And I can do that because I have a partner who wants to co-invest with me and help me get to my 20% down payment. So there's substantial, we're solving for needs for people who are looking to get cash out of their home and do something with those proceeds. And
Right.
we're also solving for the biggest home accessibility challenge that we've seen in a century through our co-investments.
Very cool. I mean, the other thing I see, which is a good thing, if I want to shop for a new home and I want to move in the next year or so, I could take an equity out, have cash to come in and lower my qualifications for buying a new home. And then is there any time limit? In other words, if you invest in a home and I decide 60 days later I'm going to sell, is that okay, or do I have to wait a year or two?
It's a good question. So if we talk about how you can end the agreement, you can sell your home at any time, and you can buy us out without selling your home anytime after 3 years. There's one small caveat, which is if you do sell your home in those first 3 years, we're still happy, you're still permitted to do so. But if the home has gone down in value, we don't share on the loss in that case because it's just been too soon for us to be able to have any ability to use time in order for us to partner together. And so in that case, all we would ask for, if home prices have gone down, we don't make any money. We just ask for our initial investment.
Okay, that's fair. Well, I'm going to go to your website and show people where to find it. So this is Unison, UNISON.com. And let me click on this and bring this up. And you could talk us through the website if that's okay, Brian.
Sure, I'd be happy to do so.
Okay.
Great.
Okay.
So
go ahead.
Oh, sure. So when you come to our website, there's a couple things that you can accomplish on our website. One is a great opportunity to just learn more about how our two programs work. If you're looking to buy a home, you can learn more about our home buyer program. If you already own a home and you'd like to take some cash out of your home with no additional debt, then our homeowner program is right for you. And the goal of this program of this website is to give you more information about how this program works, answer your biggest, most common questions, and actually get started on the process. And we'll talk a little bit about how you can actually get instantaneously pre-qualified for your property, as well as for you as a customer directly from our website. And so just scrolling down, you'll start to see there's a little bit of information that explains what is our home buyer program, how does it work? And what is our homeowner program, how does it work? And so maybe I could spend 30 seconds just to explain these key points so that it's clear for everyone who's listening. On the screen right here, you see our homeowner program. And what you'll see highlighted is that we can give you up to 20% of your home value as a co-investment with no interest charges, no monthly payments, and you have complete flexibility about when you decide to sell. And when you sell, if your home increases, we win together. If your home decreases, then we actually share in the loss with you. It's really that simple.
Okay, now you say up to 20%. Suppose the percentage that you invest in there, does that determine what the percentage you take at the end is? In other words, the higher...
That's correct.
Okay.
That's right. So the more that we co-invest, the more that we share in the home value with you. And so what we do is when we have a conversation with you as a prospective customer, is we talk through for your home, what are the different options in terms of how much you'd like to receive as a co-investment, and how would that translate into how much we would share in the change in value.
Okay, and there's a tool, if I remember correctly, on the website. So if I click, is it under homeowners? If I click there?
I believe so. Let's try there, and if I'm wrong, we'll switch to the other program.
Okay, so what this is, I think, has a little calculator. Tells you how you do it. Maybe it's the other one. And the one key thing I think is important is find out if you pre-qualify. And basically what you're going to do is take some summary information and get an idea whether or not it works for you. And then if you decide you want to do it, you fill out a full application and that type of thing, right?
That's right. And the key things that we're looking for in a pre-qualification is that we want to make sure that you as a prospective customer are the right customer in terms of qualifying from a credit perspective, that there's enough equity in the home in order for us to partner together.
Okay.
But we're also want to make sure that the home that we're actually partnering in together is the type of home that actually qualifies for a program. And now the good news is most homes qualify for a program. What we're checking for is that certain homes may be highly atypical for the neighborhood. Maybe it's a 6-bedroom mansion in a neighborhood of 2 bedrooms.
Right.
That's a property that is, because it's atypical for the neighborhood, unfortunately, we can't invest in that property. Same thing if it's a highly rural property. If you're out in the desert and there's not a lot of other properties around you, it's very difficult for us to co-invest in those sort of properties. But other than those sort of things, we're really looking to partner with as many homeowners as possible that can qualify for the program, and we have a very high success rate of partnering with people. Okay. And so when you go to our website, all you do is you type in your address of where you live, and we can give over 85% of customers an instantaneous decision right there on the website if they're a prospective partner.
Any restrictions on condos or high rises, anything like that?
Condos are okay. We do single family homes. We can do some 2 units. Unfortunately, we can't do 3 and 4 unit buildings today.
Okay.
But we can't do manufactured homes. But really, the majority of homes that people live in are ones that we qualify.
Okay. Let's click under home buyers and see if that's where the calculator is. Yeah, here we are.
Great. So this calculator just gives you an example of how much we can reduce your required down payment and your monthly payment when you're looking to buy a home. And the reason that we're able to do that is because the money that we give you is not additional debt, it's not additional monthly payments. It enables you to qualify for more home, and because it gets rid of mortgage insurance. So for example, if you put in let's say a $500,000 home. Okay,
and I hit check.
Mm-hmm.
Okay.
And so what you'll see on the left-hand side is the typical way that people will buy a home, which is to get an 80% mortgage with 20% down payment coming from the buyer. In that case, the buyer needs to come up with $100,000. They need to make a monthly payment that's $2,530. That may be a challenge for certain people on the monthly payment. Scroll down to the next one, which is, let's say that you want to get a 90% mortgage and you only have 10% down. Now you have a much larger mortgage balance. Now you have to pay for mortgage insurance. And so in this case, you're lowering your down payment, but you've substantially increased your monthly payment. You're paying an additional over $500 a month just because you don't have enough of a down payment. And so with Unison, we're the best of both worlds. By co-investing with Unison, we can give you $50,000. You provide the other $50,000. And now you have the money as if you have a 20% down payment because you actually have a 20% down payment. So you are able to buy that home with $50,000 and only a $2,500 monthly payment. This example here is an example where we're providing 10% and you're providing 10%. Mm-hmm. We actually are able to work with several lenders now where you can provide a 5% down payment and we can provide the other 15%.
Okay.
So that's not in this calculator, but imagine the same scenario, but your down payment is only now $25,000 and you still have the same monthly payment. That's now possible with our home buyer program.
Okay, so in this situation, I come up with $50,000 less out of my pocket and I save $200 or $500 a month in monthly payments. And in exchange for that, I'm going to give you a percentage of the equity above $500,000, even though I've really, in essence, only bought the property for $450 because you put 50 in, right?
That's right. I mean, you can think about it as, the way I like to think about it is you have contributed, in this example, half of the down payment.
Right.
And we've contributed the other half of the down payment. So we're kind of coming in together with the same amount of equity together. And you get all the benefits of home ownership. You get to live in it. You get to have your life there. And even though we're putting in half of the down payment, we're not sharing in half the down payment. We're typically sharing in less than that because of in this example. And so it's really a way we think about partnering together is we put in equity together and we share in the equity together at the end.
Okay. Now there was a calculator I saw on your website, and where I could say I could put the different amount of down payment, and it adjusted the percentage that you took at the end. The percentage. Do you remember where that was? Was that under homeowner?
Perhaps, or there may be Why don't you scroll down on this one, and if not, it might be under our resource center. Otherwise, I can walk through it verbally on how we think about it. So how about that? How Unison Homeowner works? There was a button up there. Let's try that.
Yeah. That's the one. Yeah. Okay.
Great.
So in this situation, we're still using the 500,000. Okay.
That's right. That's right. And so in this example, we're assuming there's a home of $500,000, and the default example that we have on here is that we've made a $50,000 co-investment.
Right.
And so for this example, what we would do in this example is share in 35% of the change in value up or down. Remember, it's only the change in value. It's the amount above 500,000. And so if you want to increase our share of the amount that we co-invest with you, our share in the change in value would increase. And if you want us to share in less, you can also just reduce the amount that we co-invest in. So for example, if you reduce it, yeah, you can go ahead to,
give me a number.
Yeah, 65,000, for example. Let's go 65,000. That's pretty close.
Yeah.
So you'll see in this case, if you want us to co-invest $65,000, we would share in about 45, 46% of the change in value in this case.
Okay.
If we make a co-investment of $100,000, if you go all the way to the end, what you'll see is we would share in 70% of the change in value. And so it sizes up or down based on whatever you feel is the right comforting amount.
Okay.
And now if you scroll down, we give you some specific outcomes that could result from that. And so actually for this case, why don't we go back to the 50,000 co-investment just to make the math a little bit easier. Good. So if we scroll down here, now we can talk about what happens in each of the three scenarios. If the home has gone up in value from 500,000 to 600,000, that means there's a $100,000 increase in the change in value. And that means that because we're sharing in 35% of the change in value here, we would make a net profit of $35,000. So we get our initial investment back of $50,000 plus $35,000 in profit.
Okay.
That means that you as the homeowner get all the existing equity in your home, all the principal that you pay down on your home, and you get the other $65,000 of that increase in value. Now let's look at the next example, which is, let's say the home goes down in value. It's gone from 500,000 to 400,000. And so the home has gone down in value by $100,000. That's a case where we would actually share in that loss. We take a loss of $35,000 on our co-investment, which means we would receive our initial investment minus our share of the loss. So you're actually paying us back less than we gave you in the first place. And in the final example, if the home just stays constant, if it's still worth $500,000, all you do is you give us our initial investment back. We've made zero profit on it. And so it really is as simple as investing in a stock. You can think about it as if the value goes up, that's when we share in the gain. If it goes down, we share in the loss with you, just like you would win and lose together.
So in a situation where Las Vegas fell in value and the rest of the country, but we really got hammered here. And we're finally back to about where we were 10 years ago. So in that situation, had I bought this house 10 years ago and the value is now back to where it was, basically I've used your $50,000 with no interest, no payments, anything, and I just give it back to you at the end in this last situation.
And that's absolutely right. And the reason, and I think it's sometimes hard for people to grasp that concept, and the reason why we can do that is because if you have an individual home prices can go up and down and fluctuate dramatically. But remember that the people that we partner with who are investing in homes, they're investing across the entire country. Okay. They're looking to get a little bit of exposure to Las Vegas, a little bit of exposure to San Francisco. And so even if one particular market maybe doesn't do quite as well, they have other markets that can help, that may have outperformed. And so they're able to better handle some of those fluctuations than an individual homeowner. That's why we're able to share in both the gains and the losses.
Okay. Is there any situation where you would invest more than the equity of what the person has? Or is it the equity or less? How's that work?
It depends on the customer and it depends on the property, but typically they do require some equity in the home. I would say it's somewhere between 30% to 20% in equity is something that we're ultimately looking for in order to qualify them. So if you only have 5% equity in the home, that's going to be a little bit more challenging. Now, remember, for our home buyer program, that's a little bit different because we're actually helping you with that down payment and first place.
Right.
And so there's a lot more flexibility to actually contribute towards there, even if you only have a little bit of equity to put in.
Well, I mean, if you're buying a home and you're increasing the amount of the down payment, you're creating immediate equity in theory right there on the spot. But in this situation where you have an existing home and this little slider, and this is something good for our watchers to watch this, you can slide this back and forth to see how much money you want to get out and how that changes the value. So if I only want $21,000 out of my property, I've just reduced this to 15% you get. And so this slider, I guess the range is 15 to 70%. So that's pretty much your range.
That's right.
Yeah. Okay.
That's right. Yeah.
Well, this is amazing, Brian. I mean, why aren't people like dialing the phone number all day long? I mean, this is great.
You know, I would say one of the exciting parts of our business is that because this is something entirely new to the world, I enjoy having conversations like this, because every one of these conversations, it's someone discovering for the first time a completely different way of thinking about home ownership, where, you know, a person can enjoy the benefits of being a homeowner and separate that from all the financial implications of home ownership. You can now pick and choose what's the right combination for you, and if you actually have the opportunity now to not tie your entire net worth into the roof over your head, what would you do with it? And that's the question that we get to ask people on a daily basis, which gets people really thinking about how would that change their life if they can do something different instead of having it locked up in their house with nowhere to go.
Well, Brian, I can't thank you enough. I mean, you've been amazing. You explained everything perfectly. It's just one of these no-brainers. I think if you're going to buy a house and you're looking for some additional money to come into it, or you want to get some money out of your existing home, this is just an amazing program. It's better than taking a loan. And you're only gambling the future. You're not gambling what you already have. That's the important thing for most people to understand.
Right. The key is that we provide total flexibility for you to live in the home that you want, with the life that you want, and you have a partner who is here to make you more successful as a homeowner, because we're aligned and we're in this together.
Perfect. Well, Brian, thank you so much, my friend. You've been wonderful. Anybody has questions, you can click the link below and we'll get you information, or you can go to unison.com. We just showed you the website. You can play around with the tools, get an idea of what's there. You can actually pre-apply and get approved. But this is just an amazing program. I mean, I'm so impressed, and I can't thank you enough, Brian, for taking your time.
Thank you. It's been a pleasure being on the show. Thank you.